Dear students, myself Naresh Kumar Dogra. Today we are going to discuss various disadvantages of accounting. If you go through the chart, you will find that accounting has a number of disadvantages, like accounting is not fully exact, it is influenced by personal judgment, accounting ignores qualitative elements, it is unsuitable for forecasting, it ignores the price level changes, it does not provide detailed analysis, and accounting may lead to window dressing. These are some of the disadvantages of accounting. Now we are going to discuss these disadvantages in detail. First limitation is accounting is not fully exact. Accounting is not fully exact in spite of the fact that most transactions are recorded on the basis of evidence, such as sale or purchase vouchers or cash receipts. Yet some estimates are also made for ascertaining profit or loss of the business enterprise. For example, estimating the useful life of an asset, providing for doubtful debts, net realizable value of closing stock, etc. That leads to inexactness of the accounting. Second limitation of accounting is it is influenced by personal judgment. As we know that accounting is not a pure science, accountants have option to exercise their personal judgments for various items which varies from person to person. For example, it is extremely difficult to predict with any degree of accuracy the actual useful life of an asset, which is needed for the calculation of depreciation. Thus, the accountants of the different firms use their own personal judgments. Due to this, the figure of profit cannot be taken as an exact figure. In the same way, users of accounts are also human beings and they are bound to react in a different manner from the same set of financial statements. Another limitation is accounting ignores qualitative elements. Since accounting is confined to monetary matters only, qualitative elements like quality of staff, industrial relations, public relations, cordial management, popularity of the goods produced, quality and caliber of the management, satisfaction of customers, etc. These all have vital impact on the profitability of the business. These are all ignored and omitted from being recorded in the books of accounts. All these factors are of qualitative nature. Unless such qualitative factors are kept in mind, it would be very difficult to assess the future of the business and to depict the true picture of the business entity. Accounting is unsuitable for forecasting. This is yet another limitation of accounting. Financial statements depict only a record of past informations. In practice, there may be continuous changes in respect of business events such as change in the demand for the product, change in management policies, etc. Such changes do not find place in the historical recorded facts. Therefore, prediction on the basis of past events may not be much fruitful. Another limitation is accounting ignores the price level changes. Assets in the balance sheet are shown at their original value, also known as the historical cost, while those are to be shown at their current market value. Alternatively, adjustments for price level changes should be made. Thus, fixed assets do not disclose a true and fair value, particularly in case of land and building and plant and machinery, etc. The results of this practice is that The values of assets shown in balance sheet are not helpful in estimating the true financial position of the concern. Accounting does not provide detailed analysis. This is another limitation of accounting. The information supplied by the accounting in reality is the aggregate of the financial transactions of the business entity for an accounting period. This is helpful for analyzing overall results of the business. What detailed information regarding cost, revenue, and allied expenditure and profit of each product is not supplied by the accounting. Due to this, detailed analysis is not possible easily. Another important limitation of accounting is it may lead to window dressing. Window dressing means the practice of manipulating accounts so that the financial statements may show a more favorable position of the business than the actual. The management of the business entity may present financial statements to suit their own requirements by showing more or less profits than the true and fair profit. This can be done through window dressing. Accountants may show the result of the business enterprise as desired by the owners. This may be done by omitting certain accounts, increasing or decreasing the amounts of certain accounts. The decisions taken on the basis of such financial statements will be ineffective. Therefore, suitable control systems should be adopted to minimize the scope of window dressing. In the next video, we are going to discuss accounting information and its various users. Till then, thank you.